US bond yields rise again on strong factory data. Australian unemployment rises, but firms still expect labour market tightness. Next week's Australian CPI could be crucial for the RBA. And Japan's inflation is expected to moderate, but don't expect the Bank of Japan, the budge, to budge. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Dhiraj Nim explains what is driving a surge in capital investment in India and whether it can continue to drive GDP growth.
India is generally a capital deficit economy, so the higher the investment rate, the better. I do believe that higher investment rate is the centerpiece of India's potential growth story, which has seen a lot of optimism pile on in recent years.
But first, in 5 and 5 with ANZ, US Treasury yields rose another 6 basis points overnight on signs of strong factory output. That drove the US dollar up 0.2% and saw the Aussie and Kiwi dollars fall by the same amount by about 5 a.m. Sydney-Melbourne time. The Aussie is at 64.21 and the Kiwi at 59.02. The S&P 500 and NASDAQ were down between 0.2% and 0.5%. Data last night from the Philadelphia Manufacturing Index improved to its highest level since April 2022, which ANZ head of G3 Economics Brian Martin says is encouraging and shows the manufacturing weakness of the last 2 years has now passed.
The manufacturing sector is returning, and that just adds to the whole complex of, a strong economy, which means it might take that bit longer now for inflation to come back down to target. So it's all fitting with the higher for longer rhetoric that we're getting from federal officials at the moment.
Number 2, Australia's unemployment rate rose from 3.7% to 3.8% in March. That was in line with expectations. And employment fell by 6,600. ANZ senior economist Blair Chapman says the employment drop was well within a wide range of expectations and that yesterday's read was not too hot and not too cold.
The labour market's continuing to slow, so the fact that employment went backwards, the unemployment rate ticked up, even though we did see some growth in hours worked, we've got to sort of remember where we're coming from. Lots of holidays taken in January, and then February, there's still a bit of school holidays going on, and so it really is a little bit of a pickup from a sort of low base in coming out of January and December.
Number 3, Australian businesses are still expecting the labour market to remain tight, according to the NAB March quarter business confidence survey. Here's Blair again.
In contrast to the labour market data, the NAB business data sort of showed that firms are actually expecting the economy to be a touch stronger over the next few months, and very much the labour market is still tight. So around 78% of firms reported labour being a constraint on their output. And that's only down from 80% in the previous quarter.
Number 4, Blair says the unemployment rate will need to rise a bit faster in the June quarter to reach the Reserve Bank of Australia's forecasts.
We still think November is going to be the first 25 basis point cut. We've got inflation next week, and if that comes in either under or over, that could really move the timing.
Number 5, Japan releases its March CPI this morning. ANZ head of FX research Marja bin Zaman expects the annual headline rate to stay steady at around 2.8% and still above the Bank of Japan's 2% target.
Don't think that the Bank of Japan will look to raise interest rates anytime soon, because broadly the trend of inflation over a period of time has been downwards. I mean, we're looking at it come off from highs of about 4% at the start of 2023 till now.
Marja bin Zaman there. Now, in today's bonus deep dive interview, ANZ economist Dhiraj Nim explains how India's capital investment ratio has been climbing since 2017 to reach 34% of GDP, back near the historical peaks seen at the turn of the century.
There's a structural rise in capex in the sense that the public capex or the governmental capex has risen substantially. We estimate that, the central and the state governments in combination have been spending over 6% of GDP for the past 2 years on building infrastructure in the economy, which is, of course, a structural driver for investments and growth and is well documented. But at the same time, we are mindful that there is also a financial cycle at play. Now, what is a financial cycle? It's basically a co-movement of financial variables like bank credit and asset prices. The thing is that whenever a financial cycle goes into an expansionary mode in India, it also takes along with it investment rate. And the linkage can be easily established because a lot of India's capex goes into dwellings and structures, basically construction-related capex, which benefits from rising home prices or buoyant equity markets or easier bank credit. So over the last 7 or 8 years, these are the developments which have also buoyed the real estate sector in India. And I think that part of India's capex rise is probably cyclical.
And what about investment in capital, in manufacturing and in business, so separate from real estate?
Just to give a perspective, industrial capex or machinery-related capex or such like, they constitute about 40% of India's total investments, which is no smaller share, but certainly smaller than what the construction-related capex is at about 53-55% of total investments. Now, this particular part of capex has recovered, of course, to pre-pandemic levels and slightly higher than that, but it has been much less impressive than the recovery in the construction-related capex. And there's a lot of high-frequency indicators that we track that speak to this dichotomy. For example, the industrial production of construction-related goods has far diverged or is far higher than that of the capital goods. We also see this divergence in various sub-indices on the equity market between the realty indices and the capital goods indices. We also see this divergence in the loan growth data. For example, the industrial loans, that is the loans to large industries, which mostly go into capex, have underperformed quite markedly the loans that go to housing and real estate. So I do think that the industrial capex has certainly recovered from the downturn seen during the pandemic, but its recovery relative to the construction-related capex has been far less impressive.
And how close to the end of the cycle are we? Is there still some room for more growth?
So we do think that the current financial cycle and investment cycle in its current shape and format, could really peak by 2025, 2026 at about 34 or 34.5% of GDP investment to GDP ratio. Now, just to give a bit of color there, that is actually no mean feat. It's only slightly below the historical peaks of the investment rate that we have witnessed in the last 20 odd years or so. But we do think that we can delay the peaking of the investment cycle if the industrial capex picks up. Now, for industrial capex to pick up, of course, there would be certain demand-related conditions that will need to be met. We would at least expect a lot more strength in domestic and external demand conditions to persist for much longer, because that will warrant capacity expansion. And there are some encouraging signs on that front. Look, exports have bottomed out. We know that even though they are narrowly based on U.S. import demand, but at the same time, the run of domestic data in terms of domestic demand, whether it's the new orders in PMI manufacturing or various other indicators, they've been running quite strong. So we do think that domestic demand is strong enough to warrant some capacity expansion, especially over the second half of this year.
And if that happens, what would that do to India's GDP growth and its overall production capacity?
Look, I think India is generally a capital deficit economy, so the higher the investment rate, the better. I do believe that a higher investment rate is the centerpiece of India's potential growth story, which has seen a lot of optimism pile on in recent years. So though we don't think that potential growth has risen to about 8% or so, but we do think it's certainly about 6.5% to 7%, which is still very strong.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, April the 19th. Catch you next week with US GDP, Australia CPI and a Bank of Japan monetary policy meeting. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.